is all about a couple things, really. There's really two goals of Chapter 3. First of all, Chapter 3 wants to give you an overview of basically the rest of the class, which may seem a little bit overwhelming now, but like I said, with this class it is very important not to lose sight of the forest for the trees. So this may be a chapter that, especially when you're preparing your 1040, you go back and you take a look at. Because it is very effective at pulling everything together and saying, and this is what the big picture looks like. It may be a little bit frustrating now because you don't know a lot of the things in the big picture, but I do think it is important to talk about the big picture now. Otherwise, throughout the semester, which is not very long, right? We'll just be learning about concepts in isolation, and you will have no real idea on why we care or where this is going to fit in. And this chapter does one other thing. It basically lectures on some things that are not discussed anywhere else in the book. Kind of some hit and miss concepts that are important to know, but don't really have a nice place anywhere else. For example, we talk about tax rates in this class. We'll talk about the standard deduction. We'll talk about exemptions, filing status, and we're going to talk about the very basics on property transactions. Probably spend about half an hour tomorrow on property transactions. Property transactions are, it's very important, and this will probably be the only time we really get to hit it in this class, is for that half an hour. And this taxation of property transactions is one of the topics that the board examiners have decided need to be tested more on the CPA exam. So, and unfortunately, it is just not taught very much in any tax program at all. So I'm trying to change that. I'm putting together a graduate course that will be offered not this fall, but next fall. And it will be a third of the course will be taxation of property transactions, which in my opinion is very important. It is not really taught anywhere else. And the other 2/3 of the class will be taxation of partnerships, which is currently not being taught here. So hopefully that comes into play, especially if you're doing tax. You'll think about taking that course next fall. Okay, so let's look at our big picture facts here, which I do use in this chapter. Again, the big picture facts are on the first page of the book. Polly has a house in which she lives with her unemployed husband, Nick, her stepdaughter, Paige, and a family friend, Maud. She provides more than half of the support of both Paige and Maud. Maud was fatally injured in a car accident in February, and Polly paid for her hospitalization and funeral expenses. Paige, her daughter, is a gymnast. She graduated from high school last year. She has a part-time job, but spends most of her time training and looking for a scholarship to the right college. In March, Nick left for parts unknown and has yet to be seen or heard from. Polly sold her wedding ring to a cousin who was getting married. The ring cost $11,800 and she sold it for $9,000. So these are our big picture facts. Okay. So, like I said, in the last chapter, or maybe it was chapter 1, I said we will come back to this tax formula. And here we are coming back to it. We'll see it again and again. So this is the formula that we use for calculating individual income tax. We start out with our income, we take out our exclusions. For the most part, there are a couple exceptions, but for the most part, exclusions do not appear anywhere on a tax return. So that's important to know. We'll spend a whole chapter discussing exclusions from income. So if an exclusion from income, that means it is not income. Most exclusions appear nowhere on a tax return. They are just not reported. Like I said, there are 2 or 3 exceptions, for the most part, not reported anywhere. Then this gives us our gross income. Next, we subtract out our above the line deductions. Okay? This is our line that we are looking at. Okay? This book and other books also call above the line deductions as deductions for AGI. Please make sure you are aware of that on your homework and on the exam. A deduction for AGI is an above the line deduction. Why is that? Because above the line deductions are part of the calculation of AGI. Right? They go toward your AGI number right here. Okay? Next, we subtract out our below the line deductions. These are often called from AGI. From AGI. Why? Because we have our AGI here, and we are taking these deductions from AGI. I call them below the line deductions. There are two options. We have either an itemized deduction or a standard deduction. The taxpayer will take the larger of the two numbers. Next, we subtract out our personal and dependency exemptions, which we will discuss. We will discuss this in detail in this chapter, and this in detail in this chapter. This will give us our taxable income. Next, we have our tax on taxable income, which we will discuss in detail in this chapter. Subtract out our credits, our tax credits, and this will give us our tax due. We may have time to discuss tax credits, but probably not. We probably will not get to credits. So that'll give us our tax due or a refund. So let's look at what this looks like on a 1040. If you made your copy of your 1040, go ahead and get it out. Let's look at that formula at work on the 1040. All right, so of course at the top we have all of our, our taxpayer name, their filing status, which we will talk about in detail in this chapter. We have their dependents. And then we have our income. So let's look at income. So part one right here is their income. Like I said, for the most part, anything excluded from income is not going to show up on a return. There are some exceptions. If you look here, here's one. Line 8B, tax-exempt interest. There are some forms of interest that are not subject to tax. That would be an exclusion. But it is required to be reported on a 1040. Another exception is Social Security benefits. At least 15% of Social Security benefits is not going to be taxable. Maybe 100%, depending upon the taxpayer. That's one of those exceptions where it does have to be reported on the form. Also, IRA distributions and pensions and annuities. And it's just because these have both taxable and non-taxable pieces. The same thing with qualified dividends. So, that's why those are reported. And then we have our, anything in this section right here, it's either going to be called an adjustment or an above the line deductions, okay? So, and if you look specifically, I guess I should say, adjustments can come here too. Because if we look at line 12, it says business income attached Schedule C. So this is where you would report your income if you own your own business. Okay? Real estate income, attach Schedule E. So this is where you would attach income or loss if you own your own rental properties. Same thing with farm income. Now down here, we have our above the line deductions. And if you look here, line 37, this is your adjusted gross income. So basically, anything on page 1 of a 1040, this is page 1, goes toward calculating AGI. If it is on page 2, does not affect AGI, okay? If it is on page 1, it is above the line and goes toward calculating AGI. That will help you if you can understand that. If you can look at a form and see, okay, if it is on page 1, it goes toward calculating AGI. It is an above the line deduction, or it is income, basically. Let's look at page 2. Let's look at page 2 of our return. So page 2, line 40, itemized deductions or standard deduction. These are our below the line deductions. Exemptions. Notice how it's going in the exact same way as that formula we just looked at. Same order. So what we're doing is we're seeing the formula at work on the 1040 itself. This gives us our taxable income. Now we pull our tax rate, okay? AMT, we're not going to have time to talk about this class. And then here are all of our credits that might apply. Here's our taxable income, here's our tax, here's all of our credits. We're down here on line 64 is where you put payments that have already been made. So maybe withholdings from your paycheck, something like that. You have a few more credits down here. And then this is the amount that these are the amount of payments that you've made in line 74. Line 63 is your total tax. So you're going to subtract out line 74 from line 63 to get either the amount that should be refunded or the amount that you owe. The best way to understand forms, I know it sounds crazy, but you just have to read them. So I don't spend much time on forms in this class. There's kind of two different teaching pedagogies, I'd say, on teaching this class. Some instructors like to spend a lot of time on forms, having students fill out forms, talking about them. I don't. I see it as one, forms change all the time. By the time you start practicing, there'll be something else. And two, I think it's much more important to learn the law and learn how to apply it to facts and numbers. And the best way to learn how to fill out a form is just to read it and do it. If you need to read the instructions, read the instructions. It's kind of a difficult thing to teach, in my opinion. The best way to learn how to do it is just to sit down and do it. Okay. So, income, broadly defined. Income pretty much includes everything. In fact, Section 61A of the code says income includes gross income, includes income from all sources derived unless there is an exception. So what this means is we are to assume that everything is income unless there is an exception specifically stated in the code. There are some categories of items that are not considered to be income in the U.S. Let me move. The first thing that is not income is a return of capital, often called ROC, return of capital. This is your initial investment. So for example, let's say I buy a house and I spend $100,000 on buying this house. This is my initial investment. This is my capital that has been invested. If I sell this house later for $200,000, how much income will I have? $100,000, right? Not $200,000, right? Because 100 of it, or half of it, is what I have paid in. That's my money that I have invested into this. So when I sell it, I will only have income for the difference between what I paid and basically what I received. So return of capital, or your investment, is not income. I don't think that's specifically stated anywhere in the code. It's just kind of a concept of U.S. tax law that a return of capital is not income. Something else that is not income, that's along the same lines, is basically a loan. So if I make a loan to someone, let's say I make a loan to Lauren and she pays me back over time. When Lauren starts paying me back, that's not income to me, okay? Because I loaned her the money, that's my money that I loaned her, and she is now just paying me that money back. It's similar to return of capital in that I gave her the money, now she's giving it back to me. It is a wash, no income there. Another thing that is not income is something called unrealized appreciation. So let's go back to our example of the house. I bought a house for $100,000. 10 years go by, and that house is now worth $200,000, but I haven't actually sold it to anyone. Does that mean I now have $100,000 of income? No. All that means is the value of my property has gone up. But until that property basically is disposed of, there is no what we call recognition event in the tax law. A recognition event occurs basically when a property is disposed of in some way, it doesn't have to be sold, and taxes owed, basically. So I have a house, it appreciates in value, and then I sell it to a third party. Now I have a recognition event. The house is being disposed of, someone else is taking control over it. That is a recognition event. And the amount of tax owed is going to be basically the difference between what I paid and what I am receiving. And I want to take this opportunity to talk about a couple things that are not in this part of the book, but I think it's important to talk about them early because I sometimes use this terminology and I want you to know what I'm talking about when I say it. This is very, very basic tax terminology. Okay, we have a basis. Tax basis. I'm sure y'all have heard people who talk about their basis. Okay, their basis is basically, okay, just your investment. The amount you paid. So in the example I just had with the house, the basis would be $100,000. Okay? What you've paid for it, what your investment is. There are some adjustments that are made to basis. We'll talk more about those later. Okay? But you can have adjustments to basis, like for example with depreciation. That would affect your basis. You have improvements made to a property. That's going to affect your basis. Yes. Generally speaking, basis is just what your investment is, what you paid. Okay? The next term is amount realized. The amount realized is basically what you receive for it when it's disposed of. What is received upon disposition. Note that that word, disposition, does not just mean selling. Okay? It could mean trading it. Could mean contributing it to a corporation. We are talking about any time a property is changing hands, not necessarily just selling it. The next thing is gain realized. So your gain realized is the difference between your amount realized minus your basis. So in the example I just gave you, we had a house. I have a $100,000 basis. I'm selling it for $200,000. So $200,000 is my amount realized. My gain realized will be $100,000. And the last word, the last terminology, gain recognized. Now this word is very important in tax, recognized. All recognized means is taxable. Okay? So recognized means subject to tax. How this works. With gain, in the code, gain realized will equal gain recognized. So gain realized is going to be the same thing as gain recognized unless there is an exception in the code. So we have this house I was just talking about, and the house you have a amount realized for this house of $200,000 minus your basis, which is $100,000, equals $100,000 of gain realized, which is also going to equal $100,000 of gain recognized. Since it is this recognition piece that causes taxation. So you might be thinking, okay, so why even have two different words if it's going to always be the same thing? It's not always the same thing. Here's an example. What if instead of selling this piece of property, I contributed it to a partnership? Well, now there's a provision in the tax code that says if you contribute property to a partnership, you do not have to pay. There's no gain recognized. So now we have $100,000 of gain realized and $0 of gain recognized. How much? What is this taxpayer's gross income from this transaction? 0, right? 0. No taxable income from this transaction because there is a provision in the tax code that turns off gain recognition. So when I use the word in the class, is this a recognition event? All that means is this something that is going to create tax consequences? Is this a transaction that will create tax consequences? For example, we'll talk about this here in a minute. If I were to give this house as a gift to, what's your name? To Jessica. If I were to gift this house to Jessica, gifting is not a recognition event. We'll go through that here in a little bit. But gifts are excluded from gross income. So that's not a recognition event for income tax. And neither me nor Jessica will have any tax consequences as far as paying tax from that transaction. Will I have $100,000 of gain realized when I give that house to Jessica? Yes, I still have $100,000 of gain realized. But how much gain is recognized? Zero. Okay? And often, something you get in the habit of thinking about now. If you have a difference between gain realized and gain recognized, like we do when I give that gift to Jessica, it's not really the end of the story. What ends up happening is, you're right, we make an adjustment in your basis. So that later, when Jessica sells this property, she's going to be paying the taxes that I should have paid when I gifted it to her. Okay, so there are mechanisms set in place in the code to make sure somebody's still paying the taxes when it's eventually sold. It's just deferred. And the mechanism that we get there is by making adjustments to our basis. So if you can keep it in your mind as we're talking about different things, how will this affect basis? How is this going? Will it affect it at all? So we want to make sure if there's any sort of deferred gain recognition, I can promise you there is a provision in the code that is creating that deferral in their basis. So, for example, continue with this example. I gift Jessica this house. It has a basis to me of $100,000, and at the time I gift it to her, it has a fair market value of $200,000. What do you think Jessica's basis should be in this gift? You think? Actually, Jessica's basis is going to be $100,000. Because now, when Jessica sells that property to Connor for $200,000, that $100,000 of gain that was not previously recognized will be recognized. We are creating a concept of deferral of income tax by way of the basis. Okay, we are making sure there's any gain that is not recognized, it stays with the basis. So that's outside of the context of this chapter, but it is good to talk about it now because it is something that you can see over and over and over again, and I accidentally use the terminology all the time. So, this is in the book, A Partial List of Exclusions from Gross Income. You do not need to know this for the exam in this chapter, because this will be covered in detail in the chapter on exclusions. So I don't want you to be too focused on understanding all these now, learning them now. That's not the point of this chapter. Gross income includes income from all sources derived unless specifically excluded, like I said. This is a part of this slide, slide 8, is a partial list of gross income items. This is also in the book on page 3.5, Exhibit 3.2. Honestly, do you really need a list? If gross income includes income from all sources derived unless specifically excluded, do we really need a list of the things that are included in gross income? Well, no. We're just supposed to assume that it's everything. But these are some common forms of income. Continued. Common forms of income. All right. Deductions. This is slide 10. We've already talked about above the line and below the line deductions and how they work. So, one thing that you should know, AGI, which we talked about, how you get to AGI, that's all your income and above the line deductions on page 1. AGI is a very important number because AGI affects many other things. Often credits have a limit based upon AGI. Itemized deductions have limits based upon AGI. So it's very important in practice, and when you're doing your 1040 assignment, make sure your AGI is right. If it's not right, it is going to dramatically affect your grade on the 1040 assignment, first of all, and will really piss off your boss when you start practicing. Because your AGI affects so many other things on your return. So many other things have limits based on your AGI. And if you get that wrong, you are going to automatically get a lot of other things wrong. These are some common above-the-line deductions, or 4 AGI deductions, which we just saw them when we looked at our 1040. This is on slide 12. I'm going to move the camera a minute. There we go. Slide 12, deductions for AGI. These are the ones that are on page 1. Again, don't put too much focus on knowing that for this chapter. We're going to have a whole chapter where we go into detail on each of these. I just want you to understand the general picture. Okay? AGI is very important. As I just said, it affects a lot of other things. Make sure you get your AGI right. Here are some lists of itemized deductions. So itemized deductions are found on Schedule A. So if any of you printed out Schedule A, you can take a look at that. Schedule A is where all of your itemized deductions go. And in my opinion, I know I don't want you to focus on memorizing things in this class. Go ahead and memorize the deductions that are itemized. You don't have to know it for my class. But eventually, when you sit for the CPA and when you just start practicing, it is going to be one of those things that people just expect you to know. Which deductions are above the line versus which are below, and you need to know what the different itemized deductions are and what their limits are. It is one of those things that people are just going to expect you to know by virtue of being an accountant, probably whether you do tax or not. The big ones that you see that are itemized, taxes and interest. So mortgage interest, property taxes, things like that. Charitable contributions, it's a big itemized deduction. Medical expenses, casualty losses, if you pay someone to prepare your taxes, that's an itemized deduction. Investment expenses, that's an itemized deduction. Gambling losses. Hobby losses. And like I said, we'll have a whole chapter. We'll go back and we'll discuss all of these deductions in detail. Okay, the standard deduction, which is the first real concept that we start to talk about in detail in this class. The standard deduction is basically the sum of 2 items. You have a basic standard deduction. Move it again. Oh, thank you. I'm not as quick as I used to be. I used to just pop up and do it, and now I'm... Okay, we have our basic standard deduction. And then we also have our additional standard. Your basic standard depends upon filing status. Your additional standard, you only get if you are either age 65 or over, or blind. Notice you do not have to be both, one or the other is fine. Okay, here is the basic standard deduction amounts in 2016. We don't really need to worry too much about 2015. I think we're good in it. This book, at the time the book came out, this is what was available. You may still need to know 15, but at this point, we're really focused on 16. So we have a single taxpayer, and if you're single, you have a $6,300 standard deduction. Now remember, the standard deduction everybody gets. Okay, you can get the standard deduction. The itemized deduction, however, you would only choose if the sum of all your items on Schedule A are greater than your allowed standard deduction. So, to get the standard deduction, what receipts do you have to keep track of? None, right? Nothing to keep track of with the standard deduction. Everybody gets it, nothing to track. However, with Schedule A, you have to keep up with a lot of information. Okay, you have to know, how many taxes did I pay? What were my medical expenses? Well, what was my mortgage interest? How much did I tithe to my church this year? These are all the things you have to keep track of to utilize Schedule A. To utilize the standard deduction, nothing. You don't have to keep up with anything. I think it says in the book that 75% of taxpayers use the standard deduction, largely because nobody wants to keep up with all the things you need to keep up with on Schedule A. And most people that do itemize are people that own their own house, because you get to deduct your property taxes and your mortgage interest, which can be big numbers. And in Texas, it's even less common for people to itemize deductions, because you also get to deduct state income taxes. Well, we don't pay any state income taxes in Texas, so it's going to be even less common for people to itemize in Texas. Okay, so these are our numbers for the standard deduction. If you're single, you get $6,300. If you're married filing jointly, $12,600. Surviving spouse, $12,600. Head of household is $9,300, and married filing separately is $6,300. What about the additional standard deduction? In 2000s, this is the same in 15 as it is in 16, but it is $1,550 if you're single. So $1,550 if you're single, and $1,250 for all else. So let's do a couple examples here. I know there are examples in the book. You knew the examples in the book, which are pretty much exactly the same as mine. Okay, so let's say we have Mary, and then we have John, and they are married. So they're married, and Mary is 70 years old, and John is 70 years old and blind. So we want to figure out what's going to be the amount of their standard deduction. What is going to be their basic standard deduction? That's right. And there is an appendix in your book, by the way, if you have your book, which as soon as y'all get it in, please make sure you bring it to class. There is an appendix in the, I think it's in the back of your book, that has all the tax brackets, all the standard deductions, all that kind of stuff. And by the way, on your exam, I will give you a handout that has all of that information in it. So you don't even need to worry about writing it on your cheat sheets. Okay, so they're going to get $12,600 for their basic standard deduction. Are they going to get any additional standard deductions?
Yes.
Yes. Okay. So how many are they going to get? How many is Mary going to get? 1. So which number do we use? 1250. That's right. 12 plus 1250. What about John? How many is he going to get? 2, right? Because he is both over 65 and he is blind. So 1250 plus 12. And then, let's see, that's 2,500, 6,750, whatever this total is. Someone has a calculator that can add it all up. So that's going to be the total amount of their standard deduction, which would be entered on 1040, line 40. Well, here's just an example right here. We have a taxpayer, and we have someone who is single, blind, and 65 or older. So this taxpayer, because they are single, they'll get $6,300. They'll get $1,550 because they're blind, and $1,550 because they're over 65. And then we have the same scenario that we had with Mary and John up here, and this is going to be the amount of their deduction. This would be $16,350. Sorry, I sometimes forget what's in the slides and what's not. I do look at them, but I forget. Okay, some taxpayers cannot use the standard deduction. This is definitely good to know. Non-resident aliens don't get to use the standard deduction. If you have 2 taxpayers who are married filing separately and one is itemizing, if one itemizes, they both have to itemize. Also, if you have someone who's filing a return for a less than 12-month accounting period, very uncommon for individuals, but it could happen if somebody owned their own business. Okay, let's talk about this. Now, often parents have children that file their own tax return. They have their own income, that kind of thing. But they could still be claimed as a dependent, basically a dependency exemption, on their parents' tax return. So how do we determine what the standard deduction is going to be for someone who is claimed as a dependent on someone else's return? Now, we are not talking about the standard deduction on the parent's return, right? We are talking about on the return that the dependent files themselves. They are going to get a standard deduction of the greater of $1,050 or earned income plus $350. And there is a max. It's basically $6,300 is the max. Because this is the amount of regular deduction they would get if they were filing single. Now, note that the parent who is claiming a dependency exemption on them is not going to get an additional standard deduction because of this child. Okay, we are talking about the return that this child, maybe a college student, I don't know, but this dependent is filing on their own behalf for their own income. So, there are some examples in the slides. So, I know he's loud, but it is hot in here. So we have a blind child earns $200 and is claimed, this is on slide 22, and is claimed by the parents as a dependency exemption. This blind child, so we have to figure out what is basically going to be the amount of their deduction. It's going to be the greater of $1,050 or $350 plus their earned income, which is $200. So the greater of these is obviously going to be $1,050, right? So this child is going to have a basic standard deduction of $1,050 plus this child is also blind, so they are going to get $1,550 as an additional standard deduction to use on their own return. Okay, now we have a child who is earning $1,500. So we get to use the greater of $1,050 or $1,850. Obviously the greater of is $1,850. So we have a basic standard deduction for this child of $1,850. This child is not blind. And then on slide 23, the last example, we have a child who earns $6,100. So now they have $6,100 plus $350 is $6,450. Obviously, $6,450 is greater than $1,050. But remember, we have the max of $6,300. So this child is going to have a basic standard deduction of $6,300. Okay, that's how that works. Okay, the next topic that is on this chapter that is discussed really in detail and nowhere else. And you'll know, when I'll give you all out a review for the exam. It'll come via email. Again, make sure you have your notifications on D2L. I sent out an email maybe 2 days ago that said, remember, we moved classrooms to room 269. Please print out your forms for 2016. If you did not get that, then you have a problem with your notifications. If you got that, then you're good. And it'll tell you on, okay, be sure you know your dependency exemptions, be sure you know your standard deductions, etc. All right, so let's talk about our exemption amounts. So for 2016, the exemption amount is $40.50 per person. For 2015, it is $4,000 per person. Each taxpayer gets a dependency exemption. So if you have 2 spouses, their dependency exemption is going to be, in 2016, would be $8,100. Okay? If you have 2 spouses plus 2 dependents, each dependent is going to get a dependency exemption, so that would be $16,200. Notice how this is different from standard deduction. With standard deduction, you don't get to increase your standard deduction based upon how many dependents you have. You really don't. You just get a set number, and if you're over 65 or blind, you get a little more. But it's not really dependent upon how many people live with you or how many dependents you have. It may change your filing status, sure. If you're married, you may be filing jointly. If you have kids but you're not married, you may be filing as head of household, but you're not going to get additional standard deductions for each of your 3 or 4 kids that live in your house. But you will get an additional exemption amount for each of those 3 or 4 kids that live in your house, so long as they qualify as a dependent. You can't have an individual claimed by more than one person as a dependent. You see this a lot in divorces. You'll have both parents that want to claim the child, as a dependency exemption. That's not allowed. there are some rules in place that help determine which parent gets the exemption, or the parents can just draft an agreement with their attorneys that says X parent is going to get the dependency exemption for odd number of years, and this parent will get the exemption for even number of years, and the IRS will respect that. If your spouse dies during the year, you do get the personal exemption for the whole year. You don't have to prorate it. It's on slide 25. Okay, so there are tests. There are two different types of dependents. We have a qualifying child, and then we have a qualifying relative. So we're going to talk about qualifying child first. For each test, remember there are two different types of dependents, qualifying child and qualifying relative. Please know this is a little confusing. It's called qualifying child, but they don't actually have to be a child under this test. Same thing with qualifying relative. You don't actually have to be a relative to qualify under this test. It is just called that. So don't get confused by the names that Congress has given it. The four different tests, these are the four different tests for qualifying child. We have relationship, we have abode, age, and support. All right. The dependency exemption tests for qualifying child and qualifying relative apply not just for purposes of determining the dependency exemption, but for a lot of other reasons as well. Some of the reasons that the book sets out is the child tax credit, the earned income credits, the head of household, filing status, etc. So just know that these tests are used in more places than just determining dependency exemptions. Okay, so let's talk about the relationship test first. So if we look at our slides specifically on slide 28, you can see that this is the relationship test. These are the different types of relationships that are acceptable to be a qualifying child. Yes, we have son or daughter, stepson, stepdaughter. We also have brother or sister, half brother or half sister, stepbrother or stepsister. So it can be determined by marriage. And any sort of grandchildren, nieces, or nephews. What type of relationship is not covered on this test? What do y'all think? Anybody that you see is missing? Maybe you see at family get-togethers all the time.
Cousin.
Cousins, that's right. Cousins are not on this. They try to trip you up a lot with cousins. Cousins are not on the list. Someone who's been adopted qualifies. Foster children may or may not qualify. There are different rules for foster children. You should note that once a relationship has been established under this list, it doesn't necessarily go away. For example, let's say you have a stepbrother by virtue of your mom marrying, some other man. And then they get divorced. That person, according to this test, will always be your stepbrother. Even if your mom and her husband are no longer married. So once this relationship has been established, we don't take it away because of a change in circumstances, basically. Okay, abode test. Under the abode test, the child has to live with the taxpayer for more than half of the year. There are exceptions. If, for example, if the child is a student, they do not have to live with the taxpayer for more than half of the year. Or if they are away for medical purposes, that is also an exception. Then we have our age test. This is a finicky test. This is a way, honestly, if I was looking at a problem, this would be the first test that I would look at. Because age will kill it. Okay? Age, under age 19, so under 19, or under 24 if a student. The only exception is if you have somebody who is disabled. If they're disabled, they're not subject to this age test. This child is disabled. But this would definitely, for me, if I was looking at it, I would always look at that first. Oh, they're 23 years old and they're working full time, they're not a qualifying child. Doesn't matter if they live with you, doesn't matter if they're your daughter, doesn't matter if you're supporting them entirely. Doesn't matter. So let's go to our big picture facts. So we have Paige. We don't actually know how old Paige is, but we know she's graduated from high school. And we know she's working part-time. She's not in school. So does she meet the age test? We don't really know. Probably not. If she's graduated from high school, she's probably 19 or over. Probably. We don't know. But she does meet the relationship test, right? She's her daughter. She does meet the abode test. She lives with mom 100% of the year. So, we don't know. That would be the question. And the last test is support. The dependent cannot provide more than half of their own support. So the dependent can't provide more than half of their own support under this test. So let's look at an example. This is example 15 in the book. Sean is 23 years old. He is a full-time student. So he's 23. He's a full-time student. All right. First question, does he satisfy the age test? Yes, he does. Okay? Age met. He lives with his parents and an older cousin. Technically, he satisfies the abode test, but he doesn't have to because he's a full-time student. He does, which is great, but he doesn't actually have to because he would be away for education. He also lives with an older cousin. During 16, he received his support from the following sources. 30% from a job, 30% from a scholarship, so 30% from a job, 30% from a scholarship, 20% from his parents, and 20% from his cousin. So the question here is he providing more than half of his own support? Okay, scholarships don't count. It says no support. Scholarships are not considered to be support. That's out. So he is providing 30% of his own support. So yes, the test is met, so long as he is not providing more than half. Does it matter that his parents are only providing 20%? No. Doesn't matter for this test. Make sure you note that, because this test is different from this test in that way. Okay? This test, the parents don't have to provide more than half the support. The dependent just can't provide more than half of their support. Okay? What about, let's say, what if the cousin wanted to claim him as a qualifying child? Does that work? No. Why?
Cousins don't count.
That's right. Cousin does not meet the relationship test. Okay, this is on slide 33. It's also on page 313 of your book in Concept Summary 3.2. These are some tiebreaker rules for kids in a divorce situation. Or it's basically just where you, not necessarily a divorce, but where you have more than one person that could claim that person as dependent. So it could actually be grandparents that are trying to get custody, something like that. These are the tiebreaker rules. If one of the person is the parent, that parent gets the exemption. So if you have a grandparent versus a parent, under these rules, the parent is going to win. If both people are the parents and the child lives longer with one parent, then the parent where the child lives longer is going to win. If both people are the parent and there's a joint custody arrangement where the child is living equally with both parents, then the parent with the higher AGI, another reason why we care about AGI, is going to get the exemption. If nobody is the parent, then the person with the highest AGI is going to get the exemption. Note that if you have an agreement that is put in place, the IRS will respect that agreement. Not just like you call somebody on the phone and you make an agreement. There's a form that has to be filled out where you set an agreement in writing on the IRS's form. They'll keep it.